Hey there. You've probably felt it, right? At the grocery store, when you're filling up your car, or just looking at your bills. Everything just costs more. Well, that invisible force has a name. It's inflation. And in this explainer, we're going to break down exactly what you can do to protect your money from it.
But let me start by asking you a question, a pretty direct one. Is that savings account you've been so carefully adding to actually losing you money, little by little, every single month? The answer, and I hate to be the one to say it, is probably yes.
And here's why. We're talking about inflation. Think of it as a silent wealth killer. It's this invisible force that just quietly chews away at the value of your hard-earned cash. It's the reason $100 today just doesn't stretch as far as it did a few years ago.
So let's get on the same page about what this really means. At its heart, inflation is just the speed at which prices are going up. And when those prices rise, every single dollar you have buys a little bit less of something. That's what we call a decline in your purchasing power.
And believe me, this isn't some tiny academic problem we're talking about. Just look at 2022. The US saw inflation hit 9.1%. That was a 40-year high. That means, on average, stuff got almost 10% more expensive in the span of a single year. Wild. To make this super clear, check out this example from Australia. A simple trip to the grocery store for a basket of food that would have cost you $50 back in 2000, well, today, that same basket costs over double that. Your money's ability to buy things was literally cut in half.
Okay, so here's where it really hits home, your savings. Let's do some quick math. Say inflation is cruising along at 6%, but your fancy, high-yield savings account is only paying you, what, 0.5%? In just 10 years, your $10,000 will only have the spending power of about $5,500. Ouch! And all of this leads us to a really tough pill to swallow. That old advice we all grew up with, cash is king. Well, when it comes to your long-term financial health, that's just not the best game plan anymore.
For generations, being a saver was the gold standard of being responsible. You put your money in the bank, it felt secure, and you'd watch it creep up little by little. But in the world we live in now, with inflation being what it is, that safe strategy is actually a guaranteed way to lose value over time.
This chart right here paints a pretty stark picture. Let's say you start with $50,000. With a pretty normal 4% inflation rate and a generous 1% interest rate from your bank, after a decade, that 50 grand can only buy what $36,000 buys today. You've literally lost 14 grand in purchasing power just by trying to play it safe. Now, hold on. This does not mean cash is totally useless. Absolutely not. You 100% need an emergency fund. That's your safety net, 3 to 6 months of living expenses sitting in an account you can get to easily. The real danger isn't having that safety net. It's holding excess cash on top of that, just letting it get weaker and weaker year after year. So, if the old way of thinking isn't cutting it, what do we do? Well, it all kicks off with a pretty major shift in how you think about money. It's about adopting a whole new money mindset. And here's that shift side by side. On the left, you've got the old saver mindset. It's all about hoarding cash and thinking all debt is evil. The goal is just to pile up money. But on the right, that's the investor mindset. The focus here is on owning assets that grow in value. The goal isn't just to have money, it's to make your money get out there and work for you. And the difference this makes, it's just staggering. Remember that $50,000 from before that shrank in value? Well, what if you had invested it instead? If you'd put that same 50 grand into a simple S&P 500 index fund back in 2010, it would have ballooned to over $170,000. Now that's not just beating inflation, that's building some serious wealth. All right, so you're on board, you're ready to make that shift. But what are the actual tools you use? Let's open up the inflation beating toolkit and break it down into a few simple pieces. It really comes down to 3 main types of assets. First up, stocks. This just means owning a tiny slice of big, successful companies. And you can easily do that through something called an ETF. Second, real estate. Yep, owning physical property. And third is the one a lot of people forget about, investing in your own skills to boost your income. Honestly, your ability to earn more money is your #1 wealth-building tool.
I know this might all sound a bit intimidating, but I promise, getting the ball rolling is way easier than you think. Let's just walk through the first few practical steps you could literally take today.
Okay, here's the game plan. Just 3 steps. Step 1, open an account. It could be a brokerage account or a retirement account like a 401k or an IRA. Step 2, put your contributions on autopilot. Even a small, regular amount makes a world of difference. And step 3, just start simple.
You don't have to be some stock-picking wizard. Low-cost index funds, those ETFs we talked about, are an absolutely fantastic place to begin.
And why is it so important to start now? It's because of this incredible thing called compounding. It's like a snowball effect. Your money earns a return, and then that return starts earning its own return. Seriously, look at these numbers. Investing just $500 a month with an average 8% return can grow to almost $750,000 in 30 years. Time is your superpower here.
So, there you have it. We've seen how inflation can be that silent thief, but we've also laid out the mindset and the tools you need to fight back. The path from being a saver to becoming an investor is right there in front of you. So the only real question left is, what's the first small step you're going to take to get started?